Have you ever wondered why the stock market behaves the way it does? Why do stocks sometimes surge or plummet without any obvious reason? The answer lies not just in financial reports and economic indicators, but also in the human mind. Consider the case of the dot-com bubble in the late 90s. The internet was still a relatively new phenomenon, yet it held such promise that investors were falling over themselves to pour money into any company with a .com in its name. The belief was that these internet companies were the future and would eventually rake in enormous profits. But as we now know, the bubble burst. Many of these companies, with no solid business model or earnings to speak of, went under. The stock prices that had soared to dizzying heights came crashing down. So, what happened here? This is a classic example of what behavioral economists call herd mentality. Investors, driven by the fear of missing out, started buying into these companies without any due diligence. They saw others doing it and decided to follow suit. The fear of missing out, or FOMO as it's commonly known, is a powerful psychological trigger, and it played a crucial role in the dot-com bubble. Then there's the story of Warren Buffett, one of the most successful investors of all time. Buffett is known for his value investing strategy, which involves buying stocks that are undervalued by the market. He famously said, "Be fearful when others are greedy and greedy when others are fearful." This reflects another aspect of psychology in investing, the ability to keep emotions in check and not get swayed by the market sentiment. Buffett's strategy is a testament to the importance of rational decision-making in investing. While others were getting carried away during the dot-com bubble, Buffett stayed away from the hype. He stuck to his principles and continued to invest in companies with strong fundamentals and undervalued stocks. This ability to remain rational and not get carried away by emotions is a key psychological trait that sets successful investors apart. So what have we gathered from this exploration? Firstly, the stock market is not just driven by financials and economics, but also by the collective psychology of investors. Herd mentality can often lead to bubbles and crashes. Secondly, emotions play a huge role in investing decisions. Fear and greed are two powerful emotions that can sway investor behavior. However, successful investing requires us to keep these emotions in check. Lastly, rational decision-making is crucial in investing. It involves doing thorough research and not getting swayed by market sentiment. This is where the psychology of discipline and patience comes into play. In conclusion, understanding the psychology of investing is just as important as understanding the financials. It's the key to making better investing decisions and ultimately achieving financial success. So the next time you make an investment decision, remember to check not just the company's balance sheet, but also your own emotions.